right, we might as well get started. I'm Paul Tickey with Stiles Financial, joined again with by Mark Gierak. We're both the PMs here at Stiles Financial, and in keeping with our promise a quarter ago, we are going to deliver our second installment or second edition of Quarters and Cents, where we talk about what's happened in the quarter, some things that surface that are interesting to talk about, and try to make sense of them for our audience. Like last quarter, I will kind of lead off with some conversation about the second quarter performance, maybe even integrate some comments about the first half in general, what may have influenced some of that, or just some interesting anecdotes that came about in the second quarter in terms of asset class performances. Mark will spend some time talking about earnings growth and valuations and valuation multiples and kind of the interesting dynamics happening there. I'll add some commentary about inflation. We'll talk about inflation a little bit between the two of us, and then we'll conclude with some comments about the high yield bond market as well. So to get started, the by the way, welcome, Mark.
Thanks, Paul.
To get things started, I will kind of preface by saying that the quarter was good for equity markets as a whole, but the whole market didn't participate. So, as confusing as that sounds, it'll make sense when we discuss this. But first of all, in the first half, the results in the first half, and I mean literally like through June 30th, was very similar to last year's first half, with the S&P up about 15 or 16%. Great start to the year. Anybody who's kind of seen what's been going on since June 30th, and more specifically since about July 18th, markets have definitely given back some of that gain. But more importantly, what we saw in the second quarter was a S&P 500 that was up about 4 or 5%. The problem is, and we wish you could see it, but there's an interesting kind of dissection of the markets by decile. And if you look at the market caps of the overall market by decile, meaning the top decile being the top 10% of the companies by market cap in the S&P, and so on, there was really only one decile that was positive, and that was the top 10 percentile, the biggest companies in the market. And that wasn't up even as much as the overall market. So what that's even signaling is that there was just a few of those biggest companies that were driving that performance in the market. And if that sounds like a repeat of what we talked about a lot last year with clients, it is. There was kind of that very high concentration of specific stocks that performed well, and much of the market did not participate as well. And to that point, large cap. In general, when we talk about large cap, meaning, what would you say, Mark, north of 50 billion in market cap or north of 100 billion in market cap? To put it in perspective, the biggest 10 are, closer to a half a trillion in market cap, and some even north of a trillion in market cap. So those are very, very large or mega cap companies. So specifically on the second quarter returns, large caps were up about 4.4%. And in the year to date, nearly 15%. So you can see that the first quarter was fantastic, but we would never sneeze at a 4.5% return in a quarter by large caps. But on the flip side, in that same second quarter, small caps were negative. They were down 3.3%. So you get much smaller in size of companies, and you start to see a difference in returns. And then getting into some other asset classes, if you look at international, actually emerging markets had a very good second quarter. They were about on par with large cap, and developed markets also, they didn't quite participate the same way. So you had this, again, bifurcation or difference in returns, whereas developed markets, meaning the more developed companies, was actually down or slightly down and maybe arguably flat in the second quarter. So we've had a very kind of diverse type of return profile out of not just domestic markets, but international markets as well. And when we look at bonds in the second quarter, they also, it was a mixed bag. High yield performed well, High yield was up about 2 or 3% in the second quarter, but investment grade corporate bonds were actually slightly negative by 1%. So you saw this difference in the overall bond market as well, but you also saw an overall aggregate bond market, slightly negative, and not surprising given that the yield curve moved up a bit. Interest rates moved up a bit at the long end of the curve, meaning kind of in the 5 year duration and longer, whereas the short end of the curve actually went down a little bit. And there some can argue that that might be a good sign for the economy. We're still in an inverted yield curve, but when we start to get to a more normal slope of the yield curve, meaning short end is lower than the long end of the curve, that can be a good forecaster of good things to come in the economy. But we're not quite there, and so I don't want to jump ahead to the inflation or talking about the economy. I want Mark first to kind of give us some thoughts around multiples and valuations of the market.
All right, thanks, Paul. So I guess first off is as we get further into the year here, you have more and more Wall Street analysts who are putting out their projections for 2025 earnings, and all the numbers I'm going to talk about are in relation to the S&P 500. But as it stands right now, analyst estimates are looking for greater than 10% earnings growth in 2025 compared to 2024 after the year's all over with. So that is a pretty aggressive growth number. And I guess, along with that is that market multiples are back up to 20 times, which is quite high. If you look back over the last 15 to 20 years, we're right near the high again. So that's it's a little worrisome from a valuation standpoint, given that we're still forecasting really high growth and that multiple is going to stay high. So I guess, to put some numbers to that, the current estimate in dollar terms for 2025 is, right around $270, $280 a share. If the market is able to hold at 20 times multiple, that puts it right about 5,600, which is only a couple hundred points higher than where the S&P is right now. So if at the end of 2025 that say $280 a share is achieved, and the market's trading at 20 times trailing earnings, we're only going to be 200 points higher than today, which is roughly 3 to 4%.
So it's not much.
Yeah, not much at all. So that's like I said, that just saying that implies a little bit of earnings risk, or a little bit of risk to valuations, and that if earnings don't come in as expected, you could have a little bit of a bumpy ride here. Also, not saying that earnings couldn't accelerate more than what's expected too, because that has happened from time to time.
But in your experience, the opposite, right? In other words, early expectations usually are higher than what it ends up being.
True. Initial estimates tend to be a little bit more optimistic than what gets realized. So yeah. Let's see. In terms of valuations, there's a couple sectors that we see as that do have some compelling companies. Some of the basic materials companies, some of the healthcare names that have gotten beaten up over the last year or so. They look compelling with rather cheap multiples, in that low double digit, even high single digit range. A lot of the industrial names tend to stick around that type of a earnings multiple as well, and we think there's some good companies there. But given that there's some potential headwinds to the market in terms of the valuations, bond yields are still around 5%. It's kind of it might be a good time to take a little bit of risk off and be a little bit more in the fixed income side of things, and wait for this market to cheapen up a little bit. One thing I guess to take two on this part. So along with that, if you're investing in the market, investing in the whole S&P 500, you have 500 companies. Well, with active management, you can avoid some of those earning pitfalls, and that's what we do here at Stiles. So as far as earnings growth and valuation multiples go, we are seeing a couple of headwinds. Doesn't mean the market needs to go down, but we really don't expect things to be super rosy going 4 or 5% per quarter for the short term, or at least even like the midterm. So
Yeah, no, that's good. And, you brought up a good point is that we think about valuations and we think about, the growth associated with those valuations. So, yes, basic materials, some healthcare, some industrials look attractive. We also sometimes they come attached with some lower growth rates, but you also get through that diversification a little bit smoother ride overall, too. We had a lot of conversations, I felt like, in the last couple of weeks talking about why do we own certain names that really don't grow that fast. Well, the reason is because when things are rough, they don't go down as fast either.
yeah,
And so you get sort of that smoothing of overall returns through a diversified portfolio. But your point about active management means we're not owning the whole S&P 500. Hopefully, we're choosing the names that are delivering the right returns for the amount of risk that we're taking.
absolutely. And with those lower growth rates, the lower growth rates tend to not be as great of change or a range from quarter to quarter either. So you're not going to go from a company that has revenue growth of 4 or 5% go to 12% and then go -5%. It's usually going to hang around that 5-6%.
That's a good point.
So that's what smooths out the ride, and actually that lower variability in revenue or earnings growth usually leads to, or actually you'd think it should lead to a little bit higher multiple because there's less risk in it, more predictability.
Correct. You would think. Yeah, so the quarter was mixed. It did have some good news, mixed with some kind of not so good news for certain parts of the market. But what's interesting is during that second quarter and really throughout the first half of 2024, we've seen very little volatility of the markets. And not to steal away from our conversation in our next quarters and cents, we have seen in the last month volatility return, and to some extent, pretty dramatic fashion in even just the most recent week or two. And I don't know, Mark, if you want to address volatility or anything that you've seen just in the last couple of weeks, because this quarters and cents is happening, almost in the middle of the quarter. So it's not out of the realm to talk a little bit about what's happened so far since June 30th.
Yeah. So volatility, we have seen a pretty big spike in volatility as tech stocks started to sell off. I guess it was probably about 2-3 weeks ago at this point.
Right.
We did see there's one day that S&P 500, the volatility index for the S&P 500, it did spike, I believe, up to 65 in the middle of the day, which is, just to put it in general directional terms, like that's really pretty high. I haven't seen anything that high in the volatility index since back in March
2020.
March of 2020.
Right.
So yeah, it was a pretty big move. It's been slowly coming down over the last couple weeks again here, and we've seen tech stocks rebound. So there still is an appetite for risk. That leads me to believe it was just a valuation concern. And we'll get into that too. As we move along here in the quarters and cents. But
There was also a fairly sharp intraday decline in volatility on the same day.
Actually, I just did read an article this morning that it was the largest intraday drop
Ever. Oh, okay. So it wasn't just.
No, it wasn't just you. It was big. It was roughly, it went from 65 back down to 41, so 24 points. So
Right.
Yeah, so I used to work in the volatility markets, and they were all institutional trading portfolios, and that would be the day that, if you were positioned correctly, it was a career day for you and your firm.
Right.
If you got it right, if you got it wrong, you were probably
Was it a career-ending day?
You were probably polishing up your resume. Yep.
Yeah, it was a career-ending day. That's so interesting. Yeah, so we've had a taste of volatility as the quarter, the new quarter has started, our third quarter, and with those, that kind of deep dive or deep drop in technology stocks in particular, but really a lot of the market participated in that decline. um, that's had some impact, obviously, on valuations. So that's why we wanted to kind of set aside some time on this call for Mark to talk about multiples of the market and valuations in general, and where he's seeing some opportunities when it comes to valuation. So another factor, because you talked about valuations adding some risk, we also talk about economic risk, right? And what's happening with the economy. And inflation has been a big piece of the puzzle or part of the conversation over the last 2 years. And inflation has come down. I mean, I think we're seeing some evidence that it's coming down, kind of into that 3 to 3.5% range. But some of that might be fueled by certain parts of the inflation numbers that is contributing to that. In other words, there's areas like shelter are actually in negative growth. So by that happening, and you're bringing inflation down, I'm not so sure that's saying that the rest of measured prices are really coming down the same amount.
So what are you talking about, the implied rent
Correct.
numbers? That has gone negative for housing.
It went negative.
Wow. Okay.
And so there hasn't been a lot that's gone negative, right? In other
Okay.
words, the inflation rate has come down, but what does that mean? It just means it's not going up as fast.
Right.
Whereas shelter and that implied rent has come down, so that's contributing to that lower inflation number. But is that saying that maybe the rest of those inflation components maybe aren't quite coming down as fast? And we've talked about that, and how just that stickiness, in that mid range, because we talked about it in the last quarter. Well, the move from 9% down to 4.5% was the easy part. That kind of going from 4.5 down to their target, the Fed's target of 2%, has really been the struggle. We've had some, as it relates to the economy, some recent bad job data. That's sounded the alarm on kind of a pending recession possibility. Some market forecasters are wanting to see some rate cuts. We think that there is probably a good chance, at least the Fed funds futures are pricing in at least 75 basis points. In what order that comes, we're not exactly sure. That there's basically 3 more meetings, so theoretically it might be a quarter point each meeting, or maybe they go pretty heavy the first quarter in and say let's cut by 50 basis points. But right now what's being priced in is about 75 basis points. And so that would be that would imply that they feel, one, inflation's under control, but also it might imply that there's some other economic issues lurking. And we know that the Fed targets really just a couple mandates: they target inflation and they target unemployment.
Well, that's what they're supposed to target, right?
That's correct.
There are some other things that they pay attention to and opine on, but
You're
well,
right, and sometimes even just the markets get them thinking about where rates should be as well. But right now, the issue is previous high inflation continues to hurt consumers, because the previous high inflation is still being compounded by that current positive inflation. And that's the point we made earlier: is that yes, inflation has come down, but that doesn't mean prices have gone down. It just means they're not going up as fast. And the question now becomes, as long as we're talking about the Fed and their capabilities, or I don't know if I want to use a different word, but are they cutting rates too early, or are they too late? And I don't know that I could dial that in any better. So I don't mean to kind of imply that we don't think that they're doing a great job, but this is the tricky part. They were a little slow. I think in our last podcast,
yeah,
you were
I think
fairly critical.
I think I gave them an F
You
for
gave them an
their
F for their timing.
yeah.
So now, what kind of a grade are they going to get? On the back end of cutting rates, meaning let's not drive us into a recession. Ideally, kind of we would think the worst case scenario would be a soft landing. If they can avoid even a soft landing, meaning where we don't see any negative growth, that would be a well orchestrated feat. I feel like
Right.
it would make up. Let's say it'll make up a little bit for being slow to raising rates. But as it relates to interest rates and the bond market, I think you wanted to talk a little bit about the high yield bond market. I
Yep.
alluded to it having a pretty decent second quarter relative to investment grade. But what are your thoughts about the high yield market right now?
Before we move on to the point, or onto the high yield bond market,
Yeah.
there's one other point to talk about with inflation and cutting of rates.
What did I miss?
Well, no, it's just the how the market would imply any move of
Oh,
you know
excellent.
going into the election of
100%.
our cuts being, is there some partisan politics, coming into play with how much the Fed cuts, or how quickly would they go 50 basis points before the election, or even front load it so that it, you know,
It takes action.
yeah, so
And
it takes action and helps out the economy. The Fed says that they're nonpartisan, and for the most part, I would believe that. But like we said, sometimes they expand their mandate and they do things a little bit outside of what they're supposed to be doing. So
well, and you bring up an important point just about the magnitude of the cuts and when they happen, but more important about just cuts in general. And why is that necessarily good for the economy? Why is it good for the markets? For the economy, it helps stimulate growth if there's some concerns that growth is slowing. As far as the markets, we know that long assets like stocks, like long duration bonds, in a rate environment that's decreasing, that's increasing the value of those assets. It's by which they're discounted, and so having lower rates is typically good news for long assets, and maybe even more specifically in equities, growth assets. I don't know if you agree with that or you have any other thoughts about that.
oh yeah, definitely. I mean, if you have pure discounting long-term cash flows by a much smaller number, yeah, the valuation can increase considerably. So
Right.
uh,
So we can go into the math on that some other time, but we want to finish talking a little bit about the bond market, but specifically the high yield bond market. Mark, what are your thoughts there?
yeah, so one interesting, I guess, factor of the high yield bond market, as of right now, so there's a high yield bond ETF, managed by BlackRock. Ticker on it is HYG. So only 2% of the bonds in that ETF will mature in 2025. So from a high yield standpoint, you'd think that the company's issuing those bonds. Well, if there's not going to be a bunch of bonds maturing, there's really no, I guess, what would,
Reinvest.
yeah, not reinvestment risk. The ability to refinance. There we go.
There we go.
That's what we want to say. So
So let's pretend like we just started all over and said that again.
yeah. So we're gonna start over with the high yield bond market. Take two. All right. So yeah, in terms of the high yield bond market, the iShares High Yield Bond ETF, HYG, they only have 2% of the bonds in that ETF that are going to mature in 2025. So as far as refinance risk, it's actually pretty low within high yield companies. Now, this doesn't take into consideration the fact that you could have some covenant defaults within some of these bonds. There's a term that goes along with that if a company defaults on one of the covenants in their bonds, or the terms of how the money was originally loaned to them. The refinancing of those bonds when that happens is called the pretend and lend. They pretend that didn't happen, change the terms, and then just re-lend to the company.
Rather than allowing it to default.
True.
Okay.
And usually it comes with a little bit higher rate, but and there's also the extend and lend. So they say it was a 5-year bond. The company violates a covenant. They're like, well, all right, if we just move it from a 5-year bond to a 10-year bond, all of a sudden it works out for you and your long-term viability. So there's two new terms. There's the pretend and lend, or the extend and lend.
I like that.
So yeah, learn something new every day, huh, Paul?
That's right.
But yeah, so the covenant default isn't captured in that 2% maturity. So there's not a whole lot of, we don't see a whole lot of risk there. The bigger part is that we just don't feel like you'd be getting paid for high yield bonds right now. So the current yield on the Bank of America high yield index is around 8%. Investment grade bonds, like even higher grade bonds, like A-rated investment grade bonds, you can still get 4.5 to 5 on probably like a 5 to 10 year bond. I mean, it's only 3% for the types of companies that have a lot more credit risk built in. So before we get interested in high yield bonds, we would want to see a much wider spread between investment grade and high yield bonds. So yeah, I don't know. Do you have any views on that?
No, I mean, I think you're right. I think as we that spread described expands, I think it might become more interesting, and that's kind of our role, is to keep an eye on those markets, and determine are we getting paid for that risk? Because that's a big part of how we think about things, and what is the gain we're getting for the risk that we're taking, and that should be part of any decision within a portfolio, even down to the individual stocks we own. It happens even at the level of the individual bonds. And we went through a long period, not terribly long period, but we went through almost a year and a half, 2 years, where the most, the highest credit-worthy bonds in the market, or in other words, treasuries and agency bonds, were paying us very well. And we said, well, for that virtual no risk, we were getting paid as if we were taking risk in a corporate bond that was investment grade. So we try to assess that all the time. And to your point about the spread, not wide enough to pay us for that risk, because that's essentially what you're taking. Is I think it's, one thing to say high yield is just a lower, it gives us a higher yield, but it's also because it's a lower credit rating. And while we haven't had default risk, it seems, in that market for going on longer than a decade, that could return. And we want to keep an eye on that. So while that spread might widen, and it sounds good from an investment standpoint, we also have to be cognizant of the fact, well, maybe that credit is at risk as well. So we'll keep an eye on that as well.
Yeah. So it also depends upon what point you are in the business cycle, right?
Correct.
So some of the economic data that's been coming out lately has been a little soft. There was some not great jobs information a couple weeks ago here. So it's one thing to be invested in, I guess, compressed high yield bonds, so low spread to investment grade bonds, when the economy's growing at 3 to 4%, corporate profitability looks good. You're still getting paid a reasonable amount to take that risk. But as you see the economy starting to maybe falter a little bit or slow down,
soften,
or just in general soften, that's not good for high yield bonds. And it's not the time necessarily to be in high yield bonds, because when you realize that you shouldn't be in high yield bonds, it's usually too late.
That's right. Right. You're taking a different kind of risk. So we'll finish with that. I don't want to get too much deeper into, any other conversations. We'll leave some of this for future quarters and cents. But thanks for joining us this month, or this quarter, I should say, in our second edition of Quarters and Cents. Thanks, Mark, for your insights. And we'll talk to you
Likewise,
guys
Paul.
next quarter.
All right. Have a good day.
Stiles Financial Services is an SEC fee-only RIA in Minnesota. Information presented is for educational purposes only. No listener should assume that any discussion or information presented serves as the receipt of or the substitute for personalized advice from Stiles Financial or any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Stiles Financial Services is not a law firm or accounting firm, and no portion of this program should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific needs.